Year-ahead views are a tired genre. Sell-side analysts have already been at it since last November. And now we're in the new year, and we've already had a political risk blow-up in the Middle East with the escalation in US-Iran tensions. But our approach at TS Lombard is a bit different. It's a structural approach where we identify standalone political and social impulses that will have an impact on the global economy and global financial markets. And here I would highlight three things. Let's start with the most topical. I already mentioned it, the Middle East. Note the structural driver. It's not the confrontation between the US and Iran as such. It's the combination of that confrontation with an independent variable, which is the political breakdown in Iraq, mirrored, by the way, in rioting and upheaval across the world in the last few months. But in Iraq, the principal antagonists are deeply entrenched. It's the breakdown in the Iraqi political system that has caused this. And if that breakdown progresses, the US and Iran will be sucked in, regardless of any inherent caution, which they may very plausibly otherwise stick to. And that dynamic could in turn spark a regional conflagration, a lasting oil price shock, and therefore a threat to global economic demand and growth, and the threat of a global financial bear market. My other two drivers are also structural, and they have to do with domestic political impulses. Number one, the US-China trade war. As I'm speaking now, President Trump is due imminently to sign the so-called Phase 1 deal. But that is not the end of the affair. During this election year in the US, Trump will hope that this Phase 1 deal will boost the economy and his re-election chances. And it probably will. But as the election draws near, why not raise the ante again against China? Or perhaps, or against Europe? In our view, an underestimated risk, even if a trade war salvo against Europe by Trump is limited to mere rhetoric. Third driver would be the public reaction against austerity, which means more Keynesian fiscal policies. The UK, offsetting the Brexit drag, looks like being in the lead now in fiscal expansion in the OECD area. And this could have a demonstration effect for Europe, for the rest of Europe. The question now is whether these short-term gains from fiscal expansion could lead in the long run to higher real interest rates, which would be potentially a major threat to economic growth against the background of a very large accumulated debt stock. All things considered, these political drivers chime well with the overall view of our market strategists to be short volatility in the first half of the year and long volatility in the second half. It's in the second half, pivoting around the US election, that many of these drivers will crystallize.